The top team of MD Krishna Kumar Karwa, the Managing Director, with us this morning. Seshadri Sen, Head of Research and Strategist, and Nirav, Sheth, of course, CEO of Institutional Equities at Emkay Global, with us. So the reason we have the top team of MK in is because they have their conference coming up, which will be featured exclusively on NDTV Profit. So remember, if you want to tune in for a lot of those interesting conversations, here's where you need to be. But sort of to set the stage, and welcome, gentlemen. Great to have you in our studios. Yeah, and on a great day, on a good morning when markets are seeming good, but after a very, very rough week and a bout of volatility, uncertainty, whatever you call it. Now, your pre-conference note, I was going through it, and you talk about how India's fortress balance sheet will withstand all rough weather. Let's start with that theme, because if anything, the events of the recent week have shown us how susceptible we are to global weather, right? Mm-hmm. We are tracking what's happening in US markets very, very consistently.
So, let's look at this way. Okay, we are tracking global markets, no doubt, but last 3-4 days, FPI sold some 17,000-18,000 crores worth of stock. Domestics again bought 17,000-18,000 back to back. Every day, whatever they sold, we bought. So that's the resilience of the Indian domestic investors. Yes, there can be stock corrections. Coming back to your theme about the resilience of India's balance sheet, look at our fiscal deficit, look at our current account deficit, look at the corporate balance sheets, hardly any debt on them. So corporates are very strong. India is very, government is managing the show very strong. And in fact, even in the budget also, they reduced the fiscal deficit target versus what they did in the interim budget. So all this gives you hopes that yes, there can be global turbulences, etc. But Indian economy will continue to move forward, and so will the corporates will keep on delivering. There will be bouts of valuations which will be euphoric or out of whack, etc., where there will be corrections, etc. But corporate balance sheets, actually, that's what we should be focused on, and they are very, very strong.
You use two words, euphoric and out of whack, to describe valuations. Is that where we are right now? Euphorically out of whack?
No, there will be segments. There will be segments where could be valuations could be which you cannot explain, and where there are momentum in the sector, etc. But maybe are we discounting 3 years down the line, 4 years down the line? That could be a possibility. But at the same time, there are opportunities where valuations are reasonable, where sectors have gone through their own consolidation in the last few years, and that's where the opportunity for investors to invest in is there.
Mr. Sen, I'll just start with the more recent event before your note. RBI's maintained a hawkish stance, largely in line with what we were expecting. How do you view the local rate cycle playing out in the near to medium term and the impact of that on equities?
Well, in the near term, we don't think there will be too much change. I think the RBI's comments, despite 2 members voting for a rate cut, made it clear that until inflation is brought under control, the RBI is not going to do much. However, if the Fed does start cutting rates later in the year, some say September, and we don't know, the data changes almost every 3 days. Then the RBI may be in a position, may have to start looking at cutting rates. But we don't think that that's a major, if you take a 1-year view, rates will obviously be lower than where we are. But if you take a 3-month view, then it's a little more difficult to forecast. But the bigger point is that look at where the 10-year is, right? We're at the peak of the rate cycle, and the 10-year is below 7. I mean, I've been covering Indian markets since the 90s, and I can't remember peaks being so low. Meaning we used to have 9s and 9.5s on the 10-year in previous peaks. So I'm not sure that is a point we need to worry about. And the fortress balance sheet argument is, this is one of the manifestations that on the bond yield side we are peaking at much lower rates, and that gives us resilience to any global turmoil, any domestic turmoil. So I'm not sure that we, as equities investors, we need to worry too much about the rate cycle. But from 1-year perspective, I think the RBI will be cutting, and a lot of that will manifest itself at the lower end of the curve and not the longer end of the curve.
Right. Nirav, you talk to big institutional clients all the time, a lot of them sitting outside as well. It's been a tough week for global markets. We mirrored some of those movements over the last few days. Turned out we were rather insulated or far more resilient than what happened to Japan or South Korea or any of those other markets. But at the same time, we were looking stretched even last week. Do you feel like much has changed in terms of mood and sentiment when we look at the markets? Is the rally done for now? And when I say I don't expect a big correction from here on, but do you think we may spend extended periods of time consolidating at these levels before we make the next big jump?
So, it's fairly likely that you can have a period of time correction and all. But let us just try and put this in context, right? So all of us get very worried about market making new highs. GDP makes new highs almost every day. That is usual. Now, look at the last 10 years, just before you had this pullback in Japan, right?
Yeah.
Japan has given a local currency return of 12% CAGR over 10 years. India, till last week, was 14%. Now, Japan is an economy where the nominal GDP today is lower than what it was 10 years back, right? So, let us get this thing right, that India with $4 trillion economy growing at 7%, earnings growing at about 13-14% is an island of growth. What creates a lot of discomfort to a lot of us is the fact that the markets are getting re-rated, right? So all of us can make an argument that, earnings were just about okay in the current one quarter. That is what the re-rating of the market does. It makes you nervous. The fact is that you need to look at what's going to happen in the next 2 or 3 years. Where are we heading in terms of our currency? Where are we heading in terms of interest rates? Where are we heading in terms of required rate of return? Right? So, to me, the entire grounding of this bullish market is backed by a very, very strong bullish economy. Look at the participation of the breadth of the economy. Right? So, again, if you just look at the credit growth, and if you look at the credit growth for the mid-cap sector, and if you look at the SME sectors, this is RBI data, that is growing upwards of 20%, while large corporates are growing at the rate of about 4%. So it's democratization of earnings, large participation, strong, large number of companies getting listed. So right place, right time.
In this, do you think that the consumption part of the puzzle is also falling in? Because that was the question mark, right? That you're not seeing that much private capex coming in because at the end of the day, consumption is not catching up. Now you have every company in that space coming and saying, rural is outpacing urban for me this quarter. Do you think that's also coming into place to complete that picture that you're talking about?
Yeah, so part of that is that you can make an argument that to some extent, anecdotally, when you look at what the companies are saying, that a part of rural is coming back. To me, please let us appreciate that India is a very, very small pocket in terms of the listed entities and their contribution to the GDP.
Yeah.
Right? So when you are talking about the fact that consumption is not doing well, I would argue that when you look at an aggregate data, again, so I'm just coming to the same point. Look at what's happening at Flipkart. Look at what is happening at Amazon. Right? So millions of small outlets getting listed over there, and they're chirping away a part of your sales growth. Right? We are seeing that in terms of April. So, which is why, to me, it's broadening of the economy to a large extent. That is what is happening. Investments, again, right? So, you are only looking at listed entities. Now, if you look at investment to GDP ratio, I think that has gone to some 37%, and we are doing very well. So, I don't think there are any reasons to complain. So, you're putting tons and billions of dollars in data centers and warehouses and all that. And, they are not in listed space by and large.
Okay, so a lot of growth coming from the unlisted space. Understood. Where is the growth going to come from in the listed space? Mr. Sen, let me come to you. I think your report talks about the manufacturing theme dominating, and that is going to really push through more of this mids. Now, this space is being seen with a bit of caution because of the kind of run-up. Some of the valuations are frankly not making sense right now. But do you think that they will catch up in growth?
Oh, definitely. If you look at the fundamental cycle, this is a cycle of manufacturing over services, of investment over consumption. This is the long-term cycle that we are in. That doesn't mean consumption is dead, but the relative growth of manufacturing over services and investment and capex over consumption will continue. That is not about to abate. But you're right, valuations do matter. And some of the valuation froth or the excess valuation that had built up in some of these manufacturing sectors have already come off, right? In the last 2 months, you've seen some of these stocks having corrected quite deeply. You see industrials, which is probably the highest growth segment in the sector in the economy, having underperformed for the last two or 3 months. And those will continue. Those will continue. Those sector rotations will continue, probably in a little more fierce manner than we have in the last 3-4 years. Like the secular run that you had of manufacturing in terms of stock prices will now see a little more balanced stock performance from here. But if you take a 2 to 3 year view, these are definitely remain the outperformers, we think, because the growth that they're going to deliver is far in excess of what consumption and services will do. So, yeah, meaning tactically you could play around with the sectors depending on valuations, and I do believe that in this post-COVID market, valuations matter. The market's been pretty brutal on overvaluation and in a very short period of time. But if you take a 3 year view, these are the sectors which will continue to drive out performance, and both in terms of growth, earnings growth, and stock price performance.
Mr. Karwa, coming on that, domestic cyclical sectors have been the primary drivers of earnings growth. So be it real estate, be it auto, be it consumption, BFSI, they've done okay. Global cyclicals, on the other hand, are still struggling. So be it in IT, metals, oil and gas saw an 80% decline in profits YOY. I'm going to throw in specialty chemicals while we were in a conversation on that too. What have you made of earnings, and what is your nifty EPS estimates for the current year and the next year? Have you gone back and reviewed those after looking at what the India Inc. has posted?
So the earnings have been a mixed bag. I think there have been a decent amount of, most of the time, you have seen not great outperformance across the board, and there has been slight misses also. So it's not been a one-way positive as far as the earnings season has been concerned.
So, like KK was just referring to...
And hedge yourself.
No, I don't want to hedge ourselves. So, I'm fairly, very constructive on the markets. And by definition, when you're professing someone to do SIPs, you don't want to take market calls, right?
The whole idea. Hedging yourself.
Exactly.
You're saying, I don't know where this is going, so just keep adding.
No,
and 10 years later, you'll forget about it.
I think I'm again coming to the same point of time. I believe that your earnings growth rate are likely to surprise rather than not surprise over the next 3 years.
Okay, just before that, did you buy on Monday when the markets fell? How much incremental capital did you allocate? Stick your neck out and tell me that.
Let me tell you that I am 100% invested in equities.
Okay. So, no cash on the sidelines?
No cash on the
side. So, you could not make an opportunistic investment on Monday?
Absolutely. Again, let's appreciate the fact that you are talking about trying to take money out of the market and invest where?
Debt,
it's always
gold.
subject. So that is 5.5%, and then you pay tax on that, right? So I think the dividend yield even right now would be 1.5%, and you're talking about another 4 or 5% CAGR.
So if you have fresh money that comes in, you're still saying, I'm going to put my full 100 rupees in the market. I won't time this.
Absolutely. So I'm saying is that you're looking at the broader market. So there are pockets, there are euphoric pockets. I'm not very sure what you do with the railway stocks, the defense stocks. I'm no expert on that, right? I'm saying is that if you are if you want to look at ideas where there is some amount of value, if you are willing to do hard work, please come to our conference. We'll show you a host of companies, and I'm sure we'll see a lot of value. So I think there are enough opportunities in the market.
Yes. You wanted to
To
come.
what you're saying is that, see, there is something called risk appetite and asset allocation. So I think investors should be only focusing on that. Okay, what is your risk appetite and what is your asset allocation between debt, equity, etc., etc. And if you are regularly monitoring that, then you will never have such challenges, because at time to time you will be balancing. I think that is what is the key. But to exit your equity portfolio, then get in again, and those kind of things is not going to work. Stock specific, if you are looking at it, then you have to look at the individual valuations at every point of time and what is the incremental returns on the stocks that you hold. And if you think that probably they are discounting 2-3 years ahead, then you should look to book profits. I think cash calls doesn't make sense for a long-term investor. You can be lucky a few times, yes, you can be, but generally you will not be. You have to go through cycles. I mean, you only discuss about multi-baggers. Now, if you're going to have multi-baggers, that means you have to hold for 5, 7, 8 years, and there will be so many such events, right?
And you've got to do the hard work, right? You've got to pay the price for making the gains. There's no free lunch.
I just want to come back to the point quickly that you made on financials and tie this in with some of the comments we heard from the Reserve Bank of India governor yesterday, talking about the difficulty they're finding in deposit growth. Yes, credit growth has been great. You talked about that, Nirav. But the deposit growth side of things is looking a little tough. Do you see that as a problem which blows up over the next few years as far as financials go? It's a catch-22, right? How are you going to attract those household savings in? How are you going to grow deposit growth when, as Nirav explained, the markets are giving such a better return? So does that put a bit of a question mark on financials for you?
Absolutely. I think we have come out on a very cautious or a kind of a negative note on the banking sector a few months ago, because we believe that this sector is highly regulated. So it comes with, if it is doing too well, the regulator will come in to control it, because you have to do that. So there is only so much of growth that this sector can show. And there are continuously, so that's one challenge. So profitability will always be under pressure. And if versus global comparisons, our banks have very high profitability. So we will tend to go towards global comparisons. So that is going to be another challenge. And when the economy is doing well, then you don't, it doesn't make sense to invest in banks. It makes sense to invest in actual businesses. Like whichever sector, the capital goods sector, materials,
what are you
etc.,
liking the best right now?
I can't say stocks, right?
Not stocks. In terms of spaces, when you say actual businesses, in terms of spaces.
Right. So some
no
of
one
the
knows what to do with IT, for example.
No, IT is not a sector because that's not India focus. That's more global focus. It's a very, very large sector which can only grow at some 7, 8, 10%. That's not the sector where you can grow big time. You will have to, so there were the defense and the railways, etc., that you did well. Probably some of the sectors which are now coming back, maybe it could be specialty chemicals. It's gone through a two-year consolidation. Maybe it could be agrochemicals. Pharma also. Pharma has already done well. It was consolidating, but now it has made its move. So you will have to look at those sectors where you can have a multiple expansion apart from earnings expansion. And in banking, possibly a multiple expansion is not happening. We have seen a continuous degrowth in the valuation multiples of banks.
Right, so while taking a cue from that, and Mr. Sen, you can come in on that, while banks may not have it very sweet, NBFCs are doing quite well. And I'm categorizing everybody who does non-banking as well. So private banking companies, anybody playing the financial space. So we saw those numbers from BSE and NSE yesterday. Phenomenal. You look at what a Nuvama is doing, you look at what the 360 is doing. Of course, those are also expensive when you talk about the likes of Anand Rathi. Do you think a better way to play the financialization theme in India may be through some of these instruments?
Yeah, you asked for two separate categories. NBFCs, in the short term, when the RBI starts easing, tend to benefit, at least in terms of perception.
So tactically could be a good play.
They are covered by the same issues that we were just discussing on the banks, that there is very tight regulations. See, banks need to take risk. Banks and lenders need to take risk to make ROEs. The RBI very correctly is keeping a hawk eye on risk in the system, because we as a country have not taken risk in the lending side very well, right? When risk has built up, it's always ended in tears. So we think that regulation will continue to be tight, and it will be more and more difficult for lenders to make excess returns by taking risk as we go along. And in the meantime, there are some asset quality issues in certain pockets in the next 12 months. So NBFCs are different. Capital market subsidiaries, if our narrative plays out that we're in a long-term bull market, then the penetration of capital markets in the retail space is still very low. And that's, you know, to your question on deposits, I think this will continue. And you know, it's inevitable. We can't expect to go from 2,000 to 3,000 per capita income without more retail participation in the capital markets. So that's a theme. The only warning is that capital markets players tend to be deep cyclicals. When they do well, PEs and EPS expands. When it turns, both collapse.
So you'd avoid the space of wealth managers and capital market players?
Maybe wait for corrections if you get, but you're not going to get them, you know, 2 years earlier when regulation, and that's also a regulated space. For example, if you look at the AMCs, when regulation was becoming very aggressive, you got some of those AMCs at dirt cheap valuations, and some of them have doubled and tripled from those levels. But, you know, I would still keep an exposure in the capital markets place.
So one sector that you absolutely adore and think valuations are compelling, earnings are great, and the outlook is positive?
You don't get that trifecta anywhere in the bull market. So I would still say consumer durables, the auto and auto ancillary space is still, you know, pretty attractive. I think the cycle will remain strong. Again, on any sector, you have to be mindful of valuation, but that's one sector which I really like.
Okay, so more of this conversation from the MK conference. So stay tuned for that. But thank you so much
Thank you.
for coming in. We'll take a very short break. On the other side, we're